Equality of accounting equation. Equality of accounting equation. Good day, viewers. Welcome once again to Web Educate, YouTube channel that presents accounting courses. Today we are covering financial accounting, and the topic under the financial accounting we are focusing on is equality of accounting equation. Equality of accounting equation is under accounting equation, otherwise known as the balance sheet equation. Accounting equation is the accounting system under financial accounting whereby the total debit equal total credit. Whatever the amount you debited is equal the amount you credit. So today we are focusing on illustration, just a small illustration to show the effect of transactions. Every transaction in accounting, in business accounting, has two effects: the debit side effect and the credit side effect. Whatever you debit is whatever figure you debit is the figure you credit. Every debit entry must have its corresponding credit entry, and also every credit entry must have its corresponding debit entry, and that is the fundamental of financial accounting. It's very, very important under financial accounting, double entry principle. But today we are covering equality of accounting equation, and this is the underlying principles that guides double entry principle. So we are looking at this small illustration. Complete the following table. Complete the following table illustration. Example of transaction are 1, 2, 3, 4, 5, 6. We're going to complete the table. Let me divide the table into 2. So complete the following table. Buy goods on credit. Buy goods on credit. We are talking about equality of accounting equation. You find these in the balance sheet. It's either assets or capital or liabilities. Capital, asset, capital or liabilities. So the transaction has two side effects. Buy goods on credit. This is a transaction. Anytime there is an exchange of goods and services between the buyer and the seller is what we call what? Transaction. So buy goods on credit. So what is the effect? Is it asset or liability or capital? Buy goods. When you hear goods, when you hear the word goods, Goods, this is the commodity that the buyer is buying from the seller. In accounting, it is called goods. Goods, that is the stock of goods, and it is classified as what? As asset. Effect. So what? Asset. That is what happened. What is the effect? When you buy goods on credit, what is the effect in the balance sheet? The asset of stock has increased. let's assume before that here, there was no good, and the figure that we had there for goods is what? Is 0. But when we buy goods, you monetize that goods, and the monetary value of it is what? Is what you are going to debit and what you are going to credit. But now we are not talking about credit or debit or credit. What we are talking about here is what is the effect. What is the effect on either asset, capital, or liability? Buy goods on credit, that is, asset of stock has increased. I put this arrow as a symbol of increment or decrease. So increase, asset as asset, increase. And what is asset that increase? That is the stock. Stock of goods. Stock of goods. Stock of goods. And what is the other effect? That is, buy goods on credit. Accounting business is made up of both majorly on credit and cash basis. So when you buy goods on credit, that means you have not paid the owner. The stocks that you buy, that you bought, you have not paid the owner, and that is what is the effect of that on the goods? What is the effect of that credit? That means you buy it from what? From the creditor. And how do you classify that? Is it asset or liability or capital? And that is a increase in liability. Liability increase. Liability increase. And where do you find this? Where do you find that liability? The balance sheet. It is what is classified as creditor. So I close that. That is that effect. The effect is that asset has increased. And what is the asset in the balance sheet? Is stock of goods. The other effect is that, because every corresponding entry must have his corresponding credit entry. So liability increase. Liability what? Increase. The effect is that liability has what? Has increased. And what is that liability that has increased? That is a creditor. That is a creditor. Buy goods by check. Like I said, that business is on majorly two bases, cash and credit. When you buy goods by check, that means you are paid. And whenever you hear what check, that is a bank. In the balance sheet of statement of financial position, you have the non-current asset and you have the current asset. Under the current asset, there are subclassification as you have inventory, you have a receivable, you have a bank, and you have a cash, you have prepayment, you have advance, and all others. So under the current account here, you have a buy goods by check. And what is the effect of that? That is, goods has increased. And how do you classify goods what's the classification of that goods? And that is, it has increased, and that is a asset of goods. Asset increase. Asset increase. And where do you find that? In the balance sheet. You find it in the stock of goods. Stock of goods. Then what is the other effect? Buy goods by check. What is the other effect that is by check? It means that there is a cash outflow from the bank, and that is asset of stock increase, then asset of bank decrease. Asset decrease. And what is the asset in the balance sheet? You find what? Bank. Find what? Bank. And next, pay creditor by check. Creditors are those that supply goods on credit. Say buy goods on credit. Then you now pay them. What is the two side effect of that? The pay creditor, that is the creditors that are what? That have increased here, we have paid part of it. That means as what? It has decreased. That means liability does what? Decrease. And what happened again? Check. Check on asset of check. Asset of a bank that we have that we have before it has that we have it's also what? Reducing, because we are paying. We are paying. It's a pay creditor. That means the first effect is that assuming you have 100,000 here and we pay part of it, that means that's reduced. That means liability has reduced. That means liability decrease. What is that? Where do you find that in the statement of financial position? Find that in what? In the creditor. Find it in the creditor. And what is the other side effect? See, pay creditor by check. That means check. Money, there is a cash outflow from what? From our bank. And that is also asset decrease also. Asset cost. Decrease. And that's the set of what? Bank. You find that in the current assets. On the statement of financial position. Next, owner pay more capital into bank. Owner pay more capital into bank. Whenever owners bring money into the business, that means has introduced capital into the business. And we say owner pay more capital into the bank, and that is to say that he pay more capital. That means our capital has increased, and asset of what? That is asset. Asset increase. Asset increase. Then what happened? That means, where do you find the asset? That is pay more capital into the bank. That means asset of bank has increased. And what is the other effect? That is capital. Owner pay more capital. Whenever owner bring money from his private money into the business, that means that is the capital. That means capital as what? As capital increase. And where do you find out in the balance sheet? You find it in the capital also. There's no need. You find it under what? Under capital. That means capital has increase. Owner takes money out of the business bank account for his own use. Owner takes money out of the business bank account for his own use. What is that? When owner takes money out of the business bank account for its own use, the money is not being used for what? For the business. So, but that money he takes out, there is a record for it, and the record for it is that we are not going to record the name of the owner. We are going to record capital, because whenever the owner brings money into the business, it is called capital. Whenever it takes out of the business, it is still what? The capital. When it brings money, capital increase. When it takes money out, capital decrease. So, what does it take out? It take out business money out of the business bank account. And what is that money? That is an asset. That means the money that we have in the what? In the bank has reduced. That is asset. Money is what? Is asset. Asset decrease. Asset decrease. Asset decrease. Asset decrease. Asset decrease. And when you find that in the balance sheet, you find it what? In the bank, because we are talking about bank here. Said owner takes money out of the business bank account for his private use. That means the capital I introduced before, the capital has what? Has started reducing. Capital decrease. Capital decrease. See, find it under what? Under capital. Capital decrease. Then next, owner pay creditor from private money. Owner pay creditor from private money outside the firm. I've said it, whenever owner is taking money into the business or taking money out of the business, it is called what? Capital. You can never find the name of what? Of the owner there. What you'll be seeing is the capital, the business. Why? It's because business stand on its own. Business stand on its own. So that the business and it's called legal entity concepts. Called entity concept. That is, the business itself is is an entity that can stand on its own. They have a legal existence. So, for example, if there is a damages against the business or against the company, and the company is being sued, it is not the owner that is being sued. It is what? It is the business. It is the business that is being sued. The business who can sue others also. It is not the owner. So the business is what is sued, or it can be sued in the court of law. So it's recognized what? As a legal person, can stand on his own. And that is why when the owner pay creditor from private money outside the firm, the money he pays outside the firm is the capital. It is what? It is called capital. Then what happened? He pay money. The owner pay creditor from private money outside the firm. That means what happened there? Our creditor that are owing us what? Has decreased. Then capital also what? Capital also. Then the capital, it bring money. That means capital has what? Has increased. While the creditor has what? Has reduced. That is the creditor. The figure that we had before as because we pay them. That means liability decrease. And where do you find that? And that is under creditor. That is under creditor. That is under creditor. And what is the other effect? That is capital as what? Has increased, because it means that the business did not have money. The business does not have enough at that time, and the owner bring in more money. Well, and I've said that whenever I bring in money, that is capital. Capital increase. Whenever it takes out money, that is capital has decreased. So that is that about today's lecture. And that about today's lecture. We have been finding the course valuable. We have derived some value from the lecture. Please do give us a thumb up telling us that what you like our presentation. I also I want you to also subscribe to the channel, making sure that you press the red button. Shows that you want us to produce more of this in the future. And also, whenever we produce more of this in the future, YouTube will be able to notify you for more of a valuable lecture as this. We are not covering only financial accounting, also cost accounting, and as time goes on, all the courses under financial accounting for your academic exam purposes and for your professional exam purposes. Do subscribe to the channel by pressing the red button. As you do so, God bless you. See you in the next video.